Energy stocks will double by 2028 because the world needs 103 million barrels of oil every single day. And the industry that supplies those barrels has been starved of investment for a decade. That is not an opinion. That is supply math. The kind of math that does not care what is trending on your feed. Chris McIntosh, founder of Capitalist Exploits, and a guy who has spent 20 years finding asymmetric trades before the crowd shows up. Put it simply, the bill is coming due. And most investors are not even looking at the invoice. Now here is what makes this interesting. While everyone has been hypnotized by AI stocks and the Nasdaq, something broke out in the energy sector this month. A quiet, powerful breakout that almost nobody noticed. And when you see the chart I am about to show you, you will understand why Chris says this is one of the most obvious setups he has seen in years. But the breakout is not even the most important part. The real story starts with a disaster, one that took 10 years to build, and it is about to pay off for anyone positioned on the right side of it. To understand why this moment matters, you need to feel what happened to this industry. Because what happened over the last decade is the reason the opportunity exists right now. Imagine a restaurant that got food poisoning, then got robbed, then got hit by a flood. That is the oil and gas business from 2014 to 2024. In 2014, oil sat above $100 a barrel. Companies drilled everything they could find. Money poured in like it would never stop. Then prices collapsed. Hundreds of billions in market value vanished. Companies went bankrupt. The survivors did something the oil industry had almost never done before. They stopped spending. They returned cash to shareholders instead. Then shale arrived and wrecked the economics even further. More bankruptcies, more consolidation, more pain. Chris McIntosh describes it this way. Picture an empty rig yard outside Midland, Texas. Rows of drilling rigs stacked and rusting. Cranes still. Weeds growing through gravel. That image is not a metaphor. It is a photograph of an entire industry conditioned by punishment to invest as little as possible. And that discipline, that caution, born from a decade of pain, is exactly what created the supply crisis you are about to see. Because what the industry stopped doing during those 10 years is the one thing it cannot quickly undo. And that is where the numbers get really uncomfortable. Here is where I need you to pay close attention, because these numbers change everything once you actually hear them. Since 2019, nearly 90% of all upstream oil and gas investment has gone to one thing: not finding new oil, not growing production, just replacing what is already declining, just standing still. Let that land for a moment. 90 cents of every dollar spent, just to keep output from falling. Now picture a barrel of oil, 42 gallons. Out of every 10 barrels the industry produces this year, 9 of those barrels are just filling the hole left by wells that are dying. 1 barrel, maybe, is new supply. And here is the part that should make you sit up. Conventional oil fields decline at about 5.6% per year. That is the natural fade. But shale, the technology that was supposed to save everything, declines at roughly 35% per year. That is not a typo. A shale well that looks spectacular in year 1 is a shadow of itself by year 3. Meanwhile, global demand has gone up every single year for the past decade. Every year, except 2020, when the world literally shut down. Chris McIntosh calls this the replacement treadmill. The industry is running faster and faster just to stay in the same place. And the treadmill is speeding up. So what does this math mean? for the money sitting in your portfolio right now? The answer might surprise you, because it is not just about energy going up. It is about what happens to everything else at the same time. Now, I want you to notice something, because once you see this contrast, you cannot unsee it. The XOP ETF, which tracks the average oil and gas producer, peaked near $350 in the prior cycle. Today, it sits around $159. It just broke out of a multi-year trading range. That breakout is confirmed, and the companies inside that ETF are generating real cash flow, real dividends, real buybacks, priced at single-digit earnings multiples. These are profitable businesses, priced as if the worst decade in energy history is going to last forever. Now look at the other side. The S&P 500 trades at a Shiller CAPE ratio of 37 times. The only other times in history that ratio has been this high were the peak of the dot-com bubble and briefly in 2021. Think about what that means. The trade everyone owns, the one inflated by passive flows and AI excitement, is priced for absolute perfection. Everything must go right. Meanwhile, energy requires no heroic assumptions. You do not need oil at $200. You do not need a war. You do not need a miracle. As Chris McIntosh puts it, you just need the supply math to keep doing what it has been doing for 6 years. And you need valuation, which always reasserts itself eventually to do what it always does. But here is what keeps smart investors up at night. What if they are sitting on the wrong side of this trade when the repricing starts? Because there are really only two paths from here, and most people are on the wrong one. Let me be straight with you about risk, because Chris McIntosh is always straight about risk, and that honesty is part of why his research stands out. Energy stocks do not move in a straight line. Oil can spike, oil can crash, recessions dent demand. Political risk is real. But here is what is different about this moment. The structural underinvestment is not a one-year story. It is a 10-year story, and you cannot reverse it quickly. You cannot rebuild an oil field services workforce overnight. You cannot permit, finance, and drill new conventional projects in 12 months. Even if every oil company decided to spend aggressively tomorrow morning, the supply response would take years. That is path one, an empty, cheap, structurally supported trade that requires only that the math keeps working. Path two is the one most investors are currently on, a portfolio dominated by the most expensive assets in the world, anchored to an AI narrative built on a company, OpenAI, that is projected to lose $14 billion in 2026 alone, cumulative losses of $115 billion through 2029. That is the foundation of the consensus trade. One path is crowded, expensive, and needs everything to go right. The other is nearly empty, dirt cheap, and needs only arithmetic. Now, before you decide which path you are on, there is something you need to understand about timing, because the breakout already happened, and what comes next tends to move fast. So let me bring this together, because this is the part that matters most for your money. The most expensive market in the world is sitting at critical support. The cheapest sector in the world just confirmed a breakout from a multi-year range. A decade of supply destruction has done its work. The replacement treadmill is accelerating. And the companies producing the barrels the world needs every single day are priced as though the pain of the last cycle never ends. Chris McIntosh and the Capitalist Exploits team expect the average oil and gas producer, proxied through XOP, to double in price within 3 years. That is not hope. That is what happens when supply math meets steady demand and valuation reasserts itself. Gravity is not a risk, it is a schedule. Now here is the thing that separates investors who catch these moves from investors who read about them after the fact. Access to the research, the specific positions, the sizing, the full thesis behind each trade, and a way of thinking about markets that most people never learn. This video is free, and most of what gets published on Capitalist Exploit Substack is free. The thesis, the macro picture, the arguments. That is by design. Because if the thinking is wrong, you should know before you pay for it. The Insider newsletter is for investors who have decided the thinking is right and want to know where to put money, specific positions, asymmetric setups, the full research, not the summary. And here is what most people do not realize. The Insider newsletter includes a complete course on asymmetric investing, a course that teaches you how to research and find your own themes and sectors to invest in for the long term. Honestly, that course alone is worth the price of admission. And the price? Less than your daily cup of coffee. Think about that. For less than what you spend at the register every morning, you get direct access to what Chris McIntosh is thinking, what he is buying, and the framework he uses to find these setups before they show up on anyone else's screen. Right now, most investors are lying awake wondering if their portfolio is too concentrated in the same crowded trades everyone else owns, wondering if the next correction will erase years of gains, wondering if they are missing something obvious. This is that something. You can sign up for Capitalist Exploits for free. Read the free research, test the thinking, and if you have already decided the thinking is right, the Insider newsletter link is in the description below. Because in a market where everyone is watching the same screen, the edge belongs to those watching a different one entirely. The breakout already happened. The question is whether you will be positioned before the rest of the market figures out what Chris already has.